Welcome to Capital Insights. Well, it seems we've started the year 2015 with a little bit of heightened volatility in the financial markets. In fact, it's volatility that we haven't seen in some time. You know, the fact is that volatility is just a part of financial market movement. In fact, there's an old saying on Wall Street, and that saying is that nothing ever happens in linear fashion, ever. But as we look back over the last few years, and we look at a lot of the money printing that's happened by the central banks, etc., that's really lent itself to somewhat of a one-way market, kind of straight up. You know, 2013, 2014, a little bit of volatility at the end. And now all of a sudden, we're starting to see some volatility that we haven't seen in a little while. Why is this happening? Well, over the last few months, maybe the last 2-3 months, we've been talking about a number of investment themes, both in our videos and our writings. And one of those themes has been the importance of currency movements. In fact, we think in 2015, currencies, the relative movement between currencies, is going to be one of the keys to financial market outcomes. Well, over the last month, and we're filming this in very early February, we've seen heightened currency volatility. And it's really that currency volatility that's translating into the real financial markets themselves. In fact, we've seen a lot of activity, really over the last 4 weeks. The Swiss central bank has delinked their currency from the euro. Very big event. In fact, just last week, Denmark lowered their interest rates 3 times. We've never really seen that before. Canada lowered their interest rates. China lowered the band relative to where the renminbi trades against the dollar, meaning they're trying to cheapen up their currency. So we're seeing continued activity by central banks, continued activity that, again, impacts currencies and impacts relative currency movements. Whether you want to hear this or not, get used to it, because we're going to see this type of volatility continue as the year moves on. But what I wanted to talk about today, because we've talked about the importance of currencies in the past, I want to talk about the US dollar. Let's look at a chart of the US dollar, a very long-term chart. What we're looking at right now is the US dollar from about 1980 until the present. Been an up and down ride a couple of times, but what we're starting to see is that the dollar is, if you will, breaking out above a long-term declining trend line. That's important. In fact, it's one of our tenets that this year we're going to see the dollar do better than foreign currencies. Why? So not only do I want to talk about the whys of the dollar doing better, but also what that means in terms of investment activity. So let's start with the whys. Why might the dollar rally this year? Well, we already know that this year there's a very good chance that the Federal Reserve is going to be raising interest rates after 6 years of keeping interest rates academically at 0. It's been a long time, but a lot of the Fed's goals, if you will, in terms of unemployment, etc., have already been met. So, in one sense, mission accomplished? Well, in part that's true. So we think that we're going to see the Fed start to raise rates possibly as early as June or July, and maybe as late as September or October of this year, but it's going to happen. And when we look across the global financial markets, it's a very good bet that the Fed will be the only central bank raising interest rates. Academically, when a central bank raises interest rates, it's supportive of the currency. But in the current environment, with the Fed potentially being the only central bank raising interest rates, that's a support to the dollar. It just so happens that last week, the preliminary fourth quarter GDP number was reported in the United States, and that number came in at about 2.6%. You may remember last quarter we hit a 5% number, which was one of the highest numbers we've seen in the entire cycle. But it was really driven by increases in Obamacare expenditures, and those were really borrowed. So in one sense, we need to back those out in looking at pure domestic GDP. And again, we've said this for a long time now, and we think this continues ahead. We're going to see those 2.5 kind of numbers for GDP. Maybe if we're lucky, in a quarter or two, we'll see a 3. There'll be a little bit better tone to the U.S. domestic economy this year. And that's really the key. Right now in Japan, we've seen 2 back-to-back quarters of negative GDP. They're in recession. Europe, having a very, very tough time, very subdued economic activity. They're not too far away from even entering a little bit of a downturn here. And then lastly, China. Not only has China been slowing, but in their recent GDP numbers, The quarter-over-quarter growth rate in China's GDP was the lowest quarter-over-quarter growth rate in 26 years. They're slowing. So it may very well be that the United States this year, relative to global economies, is doing better. And again, that's a support to the dollar. What global capital is looking for is its highest and best use, its highest potential rate of return. And where you're going to find that is in the economy that's doing better on a marginal basis than the other global economies. That'll be the US, again a support to the dollar. And then lastly, over the last 6 years, close to $6 trillion in US dollar borrowing has occurred outside of the United States. When the Fed lowered interest rates in early 2009, whether it's global governments or global corporations, they didn't have access to the type of interest rates we were seeing in the United States in their own home countries. So what did they do? They borrowed in US dollars. They borrowed in lower interest rates. And for a while, that worked out really, really well. But you've got to put yourself in the position of a foreign borrower of US dollars who's domiciled in a non-dollar based environment. As the dollar goes higher over time, for someone trying to pay down dollar-denominated debt in a foreign currency, it gets tougher. If the dollar goes up 10%, a borrower in Europe who borrowed in dollars now has a 10% increase in the amount of money they owe. So in essence, there's a synthetic short position out there, if you will. If the dollar starts to go up, we're going to have a scramble globally for non-US based dollar borrowers to get dollars and pay those debts down. And that means that puts even further upward pressure on the dollar. So it very well may be this year that we see a nice run up in the dollar relative to foreign currencies, especially given the debasement that continues in terms of the record money printing in Japan and the newly announced ECB $60 billion per month money printing by their central bank to begin in March. So that's the whys. That may be. These are the reasons why the US dollar may do better this year relative to foreign currencies. So what does that mean in terms of our investment activities? Well, we need to remember we are in a global marketplace, and global capital seeks out rate of return in two ways. One, it certainly wants to make a rate of return on the direct investment it makes, but the second part of the story is there's also going to be a rate of return related to relative currency movements. If the vehicle you have purchased, the currency in the investment vehicle you have purchased goes up, you make money. Think about an European investor who buys a stock in the United States, and 6 months later that stock lays dead and doesn't go anywhere. They've made nothing, right? Well, if the dollar goes up 15% against the euro, as it has over the last 6 months, they make 15%, even if the asset doesn't go up. So a dollar going higher is going to mean that more capital is coming to the United States. This isn't something new. We've been seeing this over the last few years. We've been seeing the Asian community buy up real estate in California. What are they essentially doing? They're trading currencies. They're trading the yen. They're trading the renminbi for the US dollar. But the expression of that US dollar borrowing is in real estate. We're seeing exactly the same thing in the stock market. As foreigners put money into the US and gain US dollar exposure through stocks, invariably they gravitate toward large cap stocks. They gravitate toward the very, very large companies that they know well. They have a certain sense of safety in those companies, and we've seen this. If we look at the performance of the financial markets in the year 2014, large cap blue chip stocks did pretty well. Mid cap stocks, a little bit less. Small cap stocks, they were not much at all. Foreign stocks, the EFA index as it's called, down. Emerging markets, down. The MSCI World Index, ex the US, down. It's already been occurring. This movement of capital into the US dollar started in earnest in 2014, and we think continues and possibly accelerates in 2015. Watching the dollar is going to be one of the most important issues for US-based investors and really global investors. Lastly, a higher dollar usually, historically, has meant subdued commodity prices. You'll know over the last 6 months or so, we have seen a dramatic drop in the price of oil. In fact, it's one of the most dramatic drops we've ever seen. But what's accompanied that is an increase in the US dollar. Globally, commodities are priced in dollars. So as dollars go higher in value, global commodity producers can actually moderate their prices and still maintain their profits. It's one of the reasons why a higher dollar puts pressure on commodity prices. We are in a global world. We are globally interconnected. Currencies are very, very meaningful to investment outcomes. And we think, again, in the year 2015, the US dollar has the chance to go higher based on the rationales we've explained. And we need to remember, it will be very, very important in investment outcomes if indeed that happens. We've positioned portfolios for exactly that outcome, and now we monitor as we move ahead. We very much appreciate your time. We hope you find some value in these comments. We're always receptive to any questions or comments you may have. On behalf of the entire team at Capital Planning Advisors, thank you so much for your time, and we'll see you very soon.